Q4 is kind of where all the action tends to happen. And like we were talking about this yesterday, but I still have Bitcoin penciled in for 2 to 250K by end of year. That has not changed at all.
Quick shout out to today's sponsor, Katana. We'll hear more about Katana's 1 billion cat campaign later today, but for now, let's get into the episode. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. Blockworks Digital Asset Summit is back in London, October 13th through 15th. We'll have top speakers from leading global funds, financial institutions, DeFi protocols, crypto companies, and policymakers all under one roof. Think BlackRock, Circle, Coinbase, and more. Follow the link in today's show notes to buy tickets and make sure to use code BELL100 for £100 off at checkout. See you there. All right, everyone. Welcome back to another Bell Curve Roundup. You got Michael's 1 and 2, Vance, all the fellas. Buonasera.
You with your mom? You with your mom in
I'm
Italy?
with my mom, mother-son trip in Italy. It's lovely. Yeah, did Florence, Siena, and then we're here for a couple more days, and then we're out. But
Mom, if you're listening to this, I'm sorry. We have not taken you to Italy.
Florence is, I think, one of the coolest cities in Europe.
Yeah.
It's awesome. It's awesome. They had I did one of those like tours of the Duomo, that big cathedral, before it opened.
Brunelleschi.
Brunelleschi, yeah, exactly. His tomb's in the gift shop. Yep. I'm sure he'd be pumped about that.
Really? They put his tomb in the gift shop.
Yeah.
Well, they put the gift over his
around
tomb.
the tomb. Yeah, yeah.
Either way,
real estate in there. But you know what's cool about that is they finished this. The Duomo is a massive cathedral at the center of Florence. They finished it with just a massive hole in the middle. They didn't have the technology, but they just believed that someone down the line would figure out how to build a dome like that, and then literally just held the contest. This guy figured it out, built it in 14 years, first one in 1,000 years. Just the cool story.
The herringbone connects in on itself, brick structure. Is how they're able to do it, because none of the trees were big enough, because every other dome, you had to put a tree across to be able to hold it in from caving in on itself. And they couldn't find trees big enough.
How do you have this much knowledge? I just came from there, so I knew the herringbone thing, but how do you just have this off the dome?
Impressive. No, I actually took some
a Renaissance man.
Yeah, so I actually taught a class at Yale, guest lectured a class at Yale on Renaissance architecture.
Don't encourage him.
Oh, God. All right, fellas, should we... I would love to get your guys' take on... here, I'm actually going to share this chart. But this is the type of thing that you always see around October, which is people talking about Uptober and seasonality. So... this is a chart from Ryan Rasmussen over at Bitwise. Bitcoin seasonality, average monthly performance. And as you can see, it's basically, challenged in August, and the only negative month on average is September, down 5%. But historically, the end of the year is up, October's 27% returns, 38% in November, December. Usually I look at these charts and think there's a little bit of woo-woo stuff going on here, but I'm curious if you think they're...
I like this chart. I also like Julian Timmer, the head of Fidelity Macro, posted this chart where he said when Fed has cut rates close to all-time highs, it's like 27 for 27 that you're like 10 to 20% higher. There's literally like no data to suggest that being bearish is correct. And yet everyone on Twitter is bearish. And this is, I don't even know. Maybe we pulled back a little bit in September.
It was technically down.
It was technically down, maybe a few percent, but like the October is the best month for crypto. And if you think back to prior years about what you were doing in Q4, you have the Thanksgiving where everyone meets up and they're like, holy shit, like we're up a lot. There's Christmas. It's like a similar vibe. Q4 is kind of where all the action tends to happen. And like we were talking about this yesterday, but I still have Bitcoin penciled in for 2 to 250K by end of year. That has not changed at all. And MicroStrategy is rallying. STRC, which is his perpetual preferred issuance, which actually gives him money to buy Bitcoin, is now back at par, so he can issue more. And he could get included in the S&P in December.
Right. So, and sorry, I think August was technically down and September was technically up, but we hit a low in September, which was basically the call.
Mm.
So it kind of like tracks the trend that everybody's been thinking. And I think the sentiment here is like there are some structural differences in each month. The first one is I think end of quarter or end of year for mutual funds is 9/30, which means that there's a lot of kind of like tax loss selling and and repositioning that leads to September being a down month. And obviously that's not Bitcoin specific, but when you have down financial markets, usually Bitcoin trends that, at least to a certain degree. And I think historical precedence is kind of what's leading people in this direction. Like one of the things that I think about is, and there's a lot of pundits out there. There are a lot of people that have, hundreds of thousands or millions of followers. And when is it that they make a prediction that's correct, or when is it that they make a prediction and then lead the market with that prediction? It's like sort of cause correlation. But when you've got millions of people following you, and you're calling for, a sell-off in September and October, how much are you affecting the markets with, tens of millions of people watching you?
And then there's also the reverse of that, like when the platitudes of like sell in May and go away. This was an exceptionally strong summer for crypto. Like when we were in Italy, Michael, usually when we go on vacation, everything nukes and we're not really able to enjoy our vacations.
That's why I hate vacations.
Jesus Christ. I was in Japan for the tariff tantrum, which was maybe it was such a great vacation, but it was just like this juxtaposition of like the worst possible price action and the most beautiful possible place. But the learning that I have from, and I'm diverging from my original point, the learning that I have from the Trump tariff tantrum is things can change so quickly and so dramatically. Like, Michael, we were like, ETH is at whatever 1,300, and like we're like, man, when will it get back to 4K? It's like that could be a few years. I guess we'll have to just sit tight and kind of buckle it. It's like the end of the year, and it's like 4,500 about to break all time high. Wild, how fast things can change.
Yeah, you think it'll take months or years, and it ends up taking weeks. Is the other thing. And yeah, my base case here is that I don't know what the price target is, but I would say we're looking at a 50 to 70% move in Bitcoin by the end of the year. That probably puts it somewhere between 180 and 225, I think. And I think that there's a lot of elements that lead to that. But I think the biggest thing is just like historical precedence, and it being structurally something that aligns with STRC, MicroStrategy in general, being able to raise more capital. In mid-December, it was very unlikely that they were going to get listed in the S&P 500 in the first go. Even, Robinhood didn't even get there. But the second go is where Robinhood actually did get added this last time. And now it's MicroStrategy second go. And so if it's not really, with MicroStrategy, it's not really a question of if they get added, it's really a question of when. And so if it's December or if it's March, I don't think it really matters that much. Obviously, December would probably lead to a very excited end of year in terms of price action, because now every single person who has a 401k is going to own MicroStrategy by default, and therefore Bitcoin directly, essentially. So there's just a lot of huge catalysts on the horizon. And I think, the other sentiment that I would also describe is that with positive trajectory in more of the crypto macro markets, what we are seeing is more, I'd say, excitement and fundraising from some of the crypto venture funds, which I think has a lagged effect, but it does have some effect in terms of, where is the capital flowing in? Because there's sentiment and there's obviously price action, but I think the big thing that drives all of this is flows. And so when you have a structural inflow happening, like what these digital asset treasuries companies provide, or something like getting added to the S&P 500, that's just the structural flows effect. But when you have billions of dollars that is starting to be raised, and some of the best performing funds are going to be the ones that can do it first. And I think a lot of these funds have been working on it for the past year. But I wouldn't be surprised if you start to see announcements of 300, 400, $600 million funds being raised, which may be smaller than the 2021 vintages that they raised previously, but that's fresh capital coming into the market. And I think that ultimately also kind of bolsters everything too.
You guys we were talking about on last week's podcast, like that we're so far away from being bubble territory in crypto. You guys get asked that a decent amount, like, is there a bubble in crypto? And I had a conversation with a buddy of mine who's raising this week, and they're trying to raise, somewhere in the neighborhood of like 50, 60 million. And they're backing into, like, in order for their, usually want a lead for that would take down like half the round. And there's just like a handful of funds that can do that in crypto. And I was just reminding me, like, man, that's so interesting because like in AI, you could get that's like chump change, right? Or even tons of other industries, right?
Well, I would say that the AI people that come out of the AI labs that we talk to, and we funded one very high level team that spun out of OpenAI, I think we can say it. And they are consistently impressed by the ability of crypto to marshal capital.
Yep.
Really?
They're like, holy shit, like you guys can do like big seed rounds. There's like the tokens that are super valuable. There's all like, cause like a lot of, at least at the highest level of OpenAI, like they are capital constrained. Even the hyperscalers are capital constrained. Not the crypto can answer that at the scale that they're looking for, but for the kind of smaller foundation model labs and the smaller compute efforts, I think those are pretty capital constrained still. Like there is this power law dynamic of the Anthropic round. I forget what they raised at. I think it was like 150 or something.
350.
350. No, that was OpenAI. Anthropic was like 150, 200, but like literally every, even like fund to fund that are usually investing in venture funds, we're doing like SPVs to get into that. And so there is this giant sucking sound that has meant that like the kind of earlier stage AI is somewhat capital constrained.
I would also say, like, in the same way that crypto has been this case for the last half decade or decade, people are also starting to realize that AI investing is going to look and feel a little bit probably, I would say, crossover fund like, where you are doing the Series A's, the Series B's, maybe even the Series C, D, E's of large, high potential investments, but you're also evaluating, do I want to just put this into something that's going to be highly liquid, like an OpenAI $100 billion round that I know I could sell in 2 to 3 years? Or do I want to, as crazy as it sounds, when I raise a fund to go after AI investing, do I want to just buy some NVIDIA stock? Because it's been doubling or tripling every 2 to 3 years. And it doesn't seem like that's stopping, and I can sell that any day I want. I think that there's this evaluation where it's hard for us, as fiduciaries to say, hey, we're going to charge you 2% to hold Bitcoin and ETH, but we could be investing in things and buying liquid assets that look a little bit further out the risk curve that basically our LPs don't know about or don't have access to. And like, that's exactly what they're paying us for. But and so it'd be a harder sell to say, hey, I'm going to raise a venture fund and I'm buying a third of it with putting it into NVIDIA stock. But I do think that the profile of these investments looks more similar to crypto than any other private kind of thesis area of traditional venture capital. And I think what that does is it changes the landscape, where early stage venture for AI is still pretty capital constrained, to Vance's point. You're not going to be able to go off and raise $50 million, but crypto's the same way. Like, you're not getting 5 bidders or something like that for a $50 million round. You're getting, like, where it previously was, you're getting one bid for like a $10 million round. Now you're getting 2 or 3, maybe 4, but nobody's interested in the massive rounds. And so it's still capital constrained, which is why it's not bubble territory, but it's definitely relaxing where there is more competition, frankly, that we just haven't seen in the last year.
Yeah, that's good to know. I mean, the AI dynamics I'm less familiar with. I just see, crazy headline numbers all the time, but definitely less in the weeds there. But just
when you've got OpenAI, $6.5 billion of secondary at $500 billion, like those numbers are gargantuan, but there aren't that many like $250 million Series A's in AI.
What do you know what AI's or OpenAI's revenue is roughly at this point?
I think the first half of the year was they had 4.3 billion of revenue, which means that they're probably on pace for anywhere from like 15 to 20 by the end of the year. So
It,
it's
it's
massive.
it's tripling every 6 months.
And I was thinking about this today, but like
Very
the reason
impressive.
why people are fading OpenAI so much is because we have not seen a consumer hit in 15 years. Like we just don't have any muscle memory for holy shit, everyone's using this. They have a billion users. They're all paying like between $20 and $200 a month, and they're adding ads, and they're adding an enterprise business, and they're doing all this other AGI, ASI stuff. Nobody has a prior for that. And as long as that is going to keep going up, like that's going to drive the next epoch of the internet. Crypto is going to live downstream of that. It's going to finance it. It's going to coordinate it. It's going to be a new type of capital market for it. Like crypto does not need to, nor should it be expected to be the next epoch of the internet. But we have a very solid trend powering that, and crypto fits very neatly downstream of it. So it's exceptionally bullish for crypto that AI is doing well.
Yep. And to double click into that, Instagram was the last consumer product that had over 1 billion DAUs. It's looking like ChatGPT will get there in the next year or so. They're at 800 million right now, which may be technically weekly actives, but I would imagine that it'll get over 1 billion daily actives in the next year. Snap was the closest that came to this, but never hit 1 billion DAUs. And yeah, there just hasn't been any consumer adoption category since Instagram in 2010.
Have you played around with Sora at all from ChatGPT?
I've not played around with it. I've seen all the videos. It's I don't know. Now you can kind of do anything and just say it was AI that did it and it wasn't you. It's like we're past the digital accountability phase where you can get canceled for shit.
Well, did Sam or yes or no, did he steal the GPUs from Target?
There's I'm not gonna say it. There's a bad video of Sam on the internet today.
Video of it.
Fake.
I actually missed
but,
this. I'm out of the loop here. What is the Sam?
There's a video of Sam. Like it looks like it's a like an internal camera inside Target, and he walks up to a shelf full of GPUs, and he pulls one on the shelf and like puts it in his jacket pocket.
Also, like when I at least use Sora, the first thing I can think of is, wow, they must just be melting GPUs. Like they need more data centers. They like the adoption leads the investment, leads the adoption. It's like this huge virtuous cycle. It's so bullish. Like, and it is a little bit suspicious that like right when the equity markets needed it most, the AI use case appeared. But still, if you read research reports about CoreWeave, everyone's like, this thing's going bankrupt. If you read, people giving their takes on the hyperscalers, so like Oracle's going free cash flow neutral to build out data centers, and like the hyperscalers are guiding too high. Like the boomers are really struggling with this idea that this is going to happen.
Well, I think there's PTSD.
Also, wait, one last thing. Mohammed El Arain, who ran PIMCO, very smart, was once considered to be on the Federal Reserve Board of Governors. Today he came out with, the gold and the Bitcoin trade. Some people are starting to call it the debasement trade. It's like, got it. You needed Bitcoin over 100K to get that going for you mentally. Like, there's so much more room to run on all of these themes.
I mean, the big thing I would call out is specifically people are talking about in terms of the build out and CapEx and all that with AI, is that you're starting to see some of these deals, especially the OpenAI, Oracle, NVIDIA deal, where it's basically vendor financing, which, in historical precedents with the build out of the internet in the 90s was Cisco lends you money so that you can go and buy Cisco products and technically count that as revenue, but you have a loan with them. And it's this whole like circular thing that unwinds at some point, because what you have to assume is that what you're building out is so valuable that you're going to be able to recoup far more of the investment dollars in a period of time that you can pay off the loan so that you don't get underwater. And what ultimately happened with the internet is we did the build out. It's just that the revenue never really showed up, or like the value of the network wasn't really as strong as we expected it would be. I would say what's fundamentally different this time is that the revenue is pacing at a level that validates there needing to be vendor borrowing so that you can build this out. And I think that the PTSD is that I've seen this before. I was there in the 90s, and I'm not saying this, but people are saying this. This is, I've seen how this ends, basically. But that is just patently different than what we're seeing now, where you're seeing OpenAI at a $10 billion or $20 billion rate doubling every 6 months in terms of revenue. And the unwind isn't really going to happen. I think it may stall, and we may get over our skis in terms of the build out, and that may happen, but that's not an unwind. That's just we've overbuilt, so we got to pull some back. Even Mark Zuckerberg said this on the last earnings call, where he said, if we overspend by $100 billion, that's 10 times better than underspending by $100 billion. And they can do it. And Meta is one of the companies, NVIDIA is one of the companies. The other thing that's really interesting about NVIDIA is they don't really have flexibility in terms of what they do with the cash that they earn. They have the most gross profit of any company in the AI space, but they've already hit regulatory hurdles in terms of buying more companies or expanding the scope. And they don't want to do a cash buyback of their stock, because it's basically signaling to the market, we don't know of any other better way of finding accretive value for this cash. And so what they're doing is they're starting to give vendor financing to people so that they can build out this AI infrastructure. Like, it does make sense.
The richest people on planet Earth have voted. We're not currently interested in your proposal as to why this will not work. The stocks are going higher, and so are the coins.
The other thing too about like ChatGPT and some of the this AI wave is that now we have the example of companies like Google and Facebook. Like I was listening to some old interview with fund manager back in like late aughts, and there was this big debate about, is Google a media company or a technology company, and they couldn't box it, so they couldn't apply the right multiples. And the Google money print, like the best money printer in the world, hadn't been invented yet, and so it's kind of like, how much money would you not throw at the opportunity to have the next Google? Like, people just did not really grok how powerful those network effects are. So I don't know. I think that's another big difference. I heard Bill Gurley talk about this too. It's just like, you have the example of like the Googles and the Facebook that just ran away with it, and no one could ever touch them again in their areas. So
I think there's also kind of like a tangential point on valuation of crypto at this point, where people can't figure out what multiple to ascribe to these things. And the range is infinity to like Gazprom's PE. Like, there's no, like, you can't even like use the median or the average. There's just no logic or framework for it. That will not always be the case. Like one example is like just like an equity comp for discussion is this company called Hippo Insurance. And Hippo Insurance is like this ex fintech darling. It was like worth 4 billion, and then it SPAC'd and it went public and it went down to like 250, 500 million. Now it's back to $1 billion. It's an okay business. They do a few hundred million of revenue a year. They're not profitable. They're expected to get to like 50 to 80 million of earnings by 2027. But it trades at $1 billion because people have faith in the disclosures, in the management, in the actual underlying business. But it's not going to be a huge business, but it's still valued at $1 billion. There's so many things in crypto that if you applied that same valuation framework, that they would be $5 to $10 billion coins. And I think, what we discuss is that there's this group of coins that are at 2 billion right now. It's like, Sky, it's like Jito, it's, Aave's pretty close. There's like 5 or 10 that are at 2 billion that I think are waiting for a valuation framework to get to 10. Clarity, as we've discussed, is probably one of the things that gets them there. But like, as much as people want to say that crypto is no longer early and there's no opportunity, I actually think the exact opposite. Like, meme stocks like Rocket Lab are now worth $25 billion. Robinhood's trading at a 60x PE. Like, the stocks are way ahead of the valuation heuristics of the coins.
I think it's a really simple, I don't think it's a valuation framework. I think that's part of it. I think it's market efficiency. Like, you've got tens of high frequency traders or hedge funds, prop desks, that are trading these stocks with near infinite, like near real time effect of any sort of filing or information or anything that they put out. Like, they're literally watching the Edgar website on the SEC's website, and they're waiting for information, and then they're trading based off of that. Like, that's the efficiencies that we're talking about in public equities markets. That just doesn't exist in crypto. And there isn't, until we can trade these things like stocks, or we can look at them with the same efficiencies as the stock market, we're never going to have a robust valuation framework. And so it's really kind of like, there isn't valuations that you can ascribe to this stuff, because it's all basically growth and momentum, or it's flows. And, I actually think one of the downsides to having cash flows back to your token is that what you provide, and you've got a robust kind of like perps market, is what you provide is a very, very strong cash and carry element, where you are incentivized to hold the underlying, stake it, earn the yield, and then short the perp. And that holds your price in line. And that basically holds down any sort of value accrual that you could possibly have. And I think that that's more instructive as to, okay, well, should we value this based off of like a price to earnings? Should we value this based off of a growth metric? But in fact, it's just really valued based off of like how robust the perps markets are and how robust people want to do the cash and carry, because there's no incentive to buy it. Like there aren't these prop desks, or there's no kind of like reason for people to step into this trade. And so the flows are such that it's balanced. So it just like stays there. It's in stasis. And I won't name anything, but there are a few assets that are like this, where you're able to earn 8, 10, 12, 15%, but the price never changes. And it's because probably the cash and carry is the most utilized asset access this asset provides.
You know who? Yeah. I just one final comment on this, actually. You know who put together, I thought, a really succinct description of kind of where we are in crypto is actually Ansem. He had a really long post on this, but this quote that stuck out of, I simultaneously believe that we've seen the peak of crypto price action driven purely on speculation about future growth, and also that we're entering the most bullish period for businesses augmented by blockchain rails. I thought that was pretty interesting. I mean, like, mostly crypto's been driven. There's a great article on this, like the Eddie Lazarin, I think, and Chris Dixon wrote back in like 2017, the price cycle of innovation. Like, price moves first and it gets everyone excited, and then it pulls more money in, and you kind of go through these speculative cycles that pulls capital on chain, and then that gets invested in some good businesses, yada yada. But it feels like that to me too, that maybe that cycle is starting to die down, but you do have these monster businesses that aren't being fully valued, or like valued appropriately. This episode is sponsored by Katana. Katana is a DeFi first chain built for deep liquidity and real yield by redirecting chain revenue back to active DeFi users. The 1 billion KAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Speaking of monster rounds, I was very curious to get your take on Flying Tulip. So Flying Tulip is a new project. There's a whole bunch of mega rounds here, actually, which is, companies finally being able to raise more money for the first time in a long time. But I was really curious to get your guys' take on this, because this is a $200 million seed round. This is another Andre project, and Andre is kind of one of these very, colorful characters in crypto. Yeah, I mean, depending on who you ask, people say very different things. He's obviously a very smart guy. He did innovate a lot on, like, especially DEX, kind of incentive design. Like, there are a lot of solidly forks that have now found their ways into pretty like big projects. Aerodrome is an example. But here, let me just describe what this is. It's basically a full.
The quick backstory on Andre, just to add a little bit more on him specifically, is he created YFI back in the DeFi summer days, which was like a fair launch asset. This is back when sort of we didn't know what the regulatory certainty would be. And so we knew that the SEC would be coming after things. This is basically like an on-chain hedge fund, but because it was distributed fairly, like, he didn't have any ownership of it. And so like that was sort of a test, I would say, in terms of, can you have something that's just distributed fairly, like a Bitcoin distribution where you stake it and earn it, and it's how the distribution, 100% of the tokens go in that way. But do something that's, very questionable in terms of regulatory status, like an on-chain hedge fund. And so he kind of pioneered this. He also kind of disappeared. And then it also came out that he was being sort of investigated or subpoenaed by the SEC over what he was doing with YFI. I mean, there were like
Those are crazy times. Not necessarily his fault.
It was not his fault at all, but like there's a lot of backstory to Andre and sort of like one of the, I would say, DeFi crypto OGs. And so he's also been working on things since in different, game ideas. And now it seems like more DeFi ideas. So generally I would say I'm very happy to see someone like him kind of feel comfortable enough to come back into the ring and, try for a bigger shot, because I think he deserves it. But yeah, this is the biggest round I've seen for a protocol.
I don't think it's 200 million of like equity capital. I think some of it is committed in kind, or sorry, not in kind. Or maybe it is in kind, but it's for kind of like liquidity bootstrapping.
I was Vance. Can I go through? I was actually going to go because it's kind of interesting mechanics here, and so it's a full stack DeFi, exchange. So spot, perps, options, lending, that type of stuff. But I'm reading directly here from Dan Elitzer, who actually participated in the round and outlined the details. So investors contribute stablecoins, ETH, or other yield-generating assets. That capital goes straight into a protocol treasury, no lockups, no team allocation. Every token issued to an investor is fully backed by the collateral that the investor contributes. Here's the twist. Every FT token comes with a perpetual put option. At any time, you can return your tokens and get your original capital back. No expiry, no games. If you exercise that put, your tokens are burned. Supply shrinks. Nobody else has anything to do. If you sell your tokens on the open market, your put protection is gone and your original capital gets routed straight into buying and burning more tokens from the market. So whether you redeem or sell, the mechanics are deflationary from day one. The catch, investors are giving up the yield that they'd earn if they just park their capital in DeFi investments. That yield is what funds the Flying Tulip's initial protocol subsidies. So your investment is really the opportunity cost of your capital, not the principal. I will say also there is another risk, which is that yield that he's talking to actually comes from rehypothecating into different yield sources. So there is also the risk that you're taking as an investor of, anything, basically like a run, right? And if too many investors try to redeem at the same time, you might not be able to get all your capital out, right? Which would cause
or they'll be able to draw you. I mean, I'm less concerned with that so long as it's built in a way that doesn't have issues. I think the meta narrative here is like, as we're seeing with things like Lighter and Aster and obviously Hype, building dexes or trading experiences still is like the most profitable thing you can do in DeFi. Maybe technically stable coins and therefore lending have more total profit, but I think the attention is on trading exchanges just because of the kind of the parabolic potential of what these exchanges can provide to token holders, especially when you're talking about an investment case where you're basically just foregoing the opportunity cost for potentially parabolic upside. And I'm sure it's not a permanent put option requirement where you've got to keep the capital in there forever. I'm sure it vests over time. You probably just lose future put options if you pull your capital out, or if you sell your assets. But I would imagine, the 200 million is definitely thought of as bootstrapping capital, not direct investment capital.
Yeah, and sorry, Vance, I interrupted you. I don't know what you're going to say, but I also would love to. I think the knee-jerk reaction that I feel like is probably missing some nuance here is this feels like a more professional or VC targeted form of yield farming. Like this is the same basic mechanics here of yield farming in a sense. I'm just curious if that comparison resonates with you.
Yeah, I think there's a huge market today for providing yield, and that is like a different category than dexes or perps, but somewhat similar of a form factor. Like right now, a lot of the TVL and DeFi is in like Athena, where the basis is not 10 or 15% like it was, but they're kind of guaranteeing you that rate on like Athena or on the Binance deposit, and then they're filling kind of the spread with like their token price and their token value. They're also doing things like unstaked USDE that's eligible for airdrops. Like all of that is just yield seeking capital. Flying Tulip is also kind of a variation of this basis trade, and so like I think the ramifications here that the basis trade continues to get more and more crowded. And so what that means is that you're going to be pushing more into like token emissions and like traditional lending yield to generate that yield. There's also a ton of capital on Plasma seeking this yield. And I don't think any of this is a bad thing necessarily. I think it's just indicative of there are $300 billion of stablecoins on chain and they're looking for something to do. And the first person that can actually put it to productive use, and we're betting that a lot of that is going to be Plasma, is going to be a huge winner. But like Flying Tulip, and even things like Superstate CC, like you're seeing the commodification of this basis trade, which is going to lower borrowing costs, but it's probably going to mute, to Michael's earlier point, the upside of a lot of these moves.
Yeah. I mean, I'm personally interested. I thought I was one of those people that got kind of nerd sniped by Yearn back in the day. I just thought it was a super cool project. And yeah, I think he was building at a time that was really difficult for crypto. I think a lot of those like early DeFi founders are just built different. The amount of risk that you had to take, not only just being a founder in a business, but taking on legal risk, like you could literally get arrested or something like that. You could lose funds. Yeah. So I'm rooting for Andre here as well.
Totally.
And yeah, I guess we'll see if it's kind of a novel funding mechanism here too. I don't know if this is like a one-off or the type of thing that could catch on, but it certainly seems like it's somewhat appealing from the investor side of things. You can get your money out. So
I think it's more aligned. Obviously, it's more capital intensive. And so maybe it's not as exciting to a fund that is limited in terms of capital. But it may be interesting to platforms or, non-venture specific funds that have more capital. Dan Elitzer with Nascent is structured a little bit differently than traditional funds, where he's doing more DeFi activity. So it's kind of purpose built for someone like him.
How do we feel about the name Flying Tulip as the last?
Not as good.
Yeah.
I mean, yeah, I'm not a huge fan either, but still support.
We don't need to give the next Andre project a ton of airtime.
Yeah.
Okay. All right. You know what I would love to get your guys' take on here is Keel. So this is a Solana focused star, which just launched on Solana. So there is a roadmap here to deploy as much as 2.5 billion into DeFi and RWA assets. So the new protocol will receive an allocation from Sky's USDS stablecoin reserves to deploy to Solana-based DeFi apps such as Camino, Jupiter, and Radium. So this is the third star in the Sky ecosystem. As a reminder, the other two are Grove and Spark. And the idea here, the model, which I'm gonna try to explain, you guys correct me, but it's almost like it's not a bank, obviously, but like the model kind of would be like a central bank and commercial banks, right? Where there's the advantage if you're a star is you get kind of preferential funding, and if you're Sky, you get to shield yourself off from some of the risk, and also diversify capital to like maybe specialized lenders, right, who could generate more yield than necessarily just Sky.
Just one specific call out, and I'd say this is kind of a consistent maybe misunderstanding that we've seen across the Sky ecosystem with Endgame coming to fruition now, is that it's not leverage per se. What you're doing is you're basically renting capital from the Sky ecosystem, and every month you're paying a fee to rent that capital based off of an interest rate. That interest rate is consistent across all stars, but you're putting up what's called first loss capital. Let's say it's $50 million, and that gets you $2 billion. So you have a 40x multiple on what you can access. But every month you're paying 5% off of the $2 billion. And so you have to pay basically whatever that monthly rate is back to Sky. And so if you, for whatever reason, are not making any revenues with the $2 billion of USDS that you have, that you're using, it's going to eat into your first loss capital. And as that first loss capital dwindles, you're not going to be able to access more USDS. You're going to have to start paying back some of that. And if you lose all of your capital, it'll be recouped. And you'll have lost your first loss capital, which is a direct equity loss. And so there is, I would say, a different type of risk model than what you'd historically seen with traditional leverage in crypto. This is more like a banking relationship where if you lose the shareholders' equity of your bank because you made bad loans, or you had to pay your fees to the Fed funds to the Fed central bank, your bank could go bankrupt, kind of thing. So it's a very, very different model.
I think this is a huge step forward for Solana DeFi. I tweeted this, but the main thing that they do not have that Ethereum had in its early days is a stablecoin allocation protocol, something that you can take and generate stablecoins against native assets like Sol, but that can also just terraform the entire landscape by providing lending liquidity into things like Camino or things like Jupiter Lend or things like Drift. And they are, even though people don't realize it, one of the largest depositors into each of those protocols today. So like if you're like, I see a lot of people doing this, like, oh man, we need to get stable coins. Can we like announce PayPal coming onto Solana? It's like, okay, that's great. It didn't really add that much. This is something that Solana as a DeFi ecosystem should get behind, because the more that you put into this, literally on a risk capital basis, you can get 40 to 50x leverage as long as you're doing safe fixed income like products, and you can grow your chain. And like, that's the thing that's really different about Sky and that entire ecosystem, is that they're actually in a position to do something about all of these adoption questions. And it's not just like trying to create a retail fervor. Like, that's just not like going door to door and asking people to deposit stablecoins onto Solana. Probably not the best use of your time. Better use of your time is getting behind projects like this and actually forcing them to contribute more to the ecosystem by putting more in yourself. So I'm super excited for this. And this will also be the first demo of the Layer 0 Sky Bridge, which is super cool because it can do math across blocks, across chains. And why that matters is because the minting and the burning, especially across chains, is like a huge stablecoin security threat model. If you can actually figure this out, that is a technological step forward for the space.
Do you guys have a sense of how stars are going to differentiate? Like, my kind of vague understanding here is even between Grove and Spark is there's one that's more of a focus on RWAs, which is a Grove, I think, and then the other is more of a focus on kind of on-chain opportunities. Maybe Keel will be focused on Solana. But I'm just wondering, is the idea that each of these things will be separate? Is this a perfect competition thing, where it's like when the Joker kind of cracks the pool cue over his knee and throws it in and says tryouts, kind of like what?
I'd love to do that at Framework sometimes, but no. I think there's first of all, think about it in terms of like, part of the competition is who can raise risk capital. If you're a Solana team and you get Solana behind you, you can probably raise quite a bit of Solana risk capital. And the Solana Foundation is backing Keel, so shout out to them for really taking the lead on that. It's amazing.
One quick point of clarification: there's internal and then external first loss capital. Internal is like you raise from a venture fund and it's permanent. External is basically you're lending assets to get a lower effective rate, but you can put assets into the first loss capital.
Right. So one is like, how much risk capital can you raise? And like, you can think of like really big stars that take, kind of small risk at large scale. And then you can think about smaller stars that are taking a lot higher, credit risk or duration risk, that are just kind of trying to be a lot more profitable on a smaller basis. There's then, the credit mix that you're going after. Is it for Grove, it's traditional finance. For Spark, it's on-chain capital on Ethereum. For Keel, it's Solana. There's a lot of different verticals and thematics you can have for lending. But I think, there's going to be a lot of competition, which is good because it'll grow the capital base that everyone's working with. But all of this is a huge step forward where, you have these USDS stablecoins that are printed, they're allocated, they're generating profits, they're recycled back into the STAR's surplus capital buffer, which is then compounding. And so that USDS is consistently generating, which is another thing that, like, when you think about stablecoins, is hard to reason about. It's a lot of people sell Solana or ETH, and then they take the stablecoin and they bring it to their bank account into their real world. Having these things stay and compound is a fundamental innovation that Sky's been able to come up with. And there's going to be things like the Plasma Star, which is pretty soon up here, and we're adding credit into that. And it's going to be a lot of our strategy in terms of these different chains is, let's get some stars spun up, let's get risk capital into them, and let's really grow those chains from a credit perspective. And that is, at least part of the bull case for Plasma, which has $7 billion of stablecoins on it. Like, imagine what you could do with that if you had 30, 40x leverage in a safe way. It's pretty incredible.
The only things I'd add are, we kind of think of it as like a 2x2 matrix. There's ecosystem across, the horizontal, then the vertical is basically like credit type, and whether or not that's like different types of risk, but it could also be types of duration as well. One thing that we don't have a good representation of right now on chain is long duration lending. Everything that's lent on chain has to be something that basically you can recall instantaneously. But what if we were able to say, like, hey, we're going to lend you at a fixed rate for a year or 2 years or 3 years, you'd be able to go after such different types of lending opportunities. And, it's people like Maple who can have, bespoke contracts with these different platforms that can have an agreement with, a counterparty for a long period of time because they have the balance sheet to be able to do that. But if you're able to do that in a more bespoke way, you'd be able to have that go direct through Sky. And Maple is also one of the largest recipients of Sky Capital. So I would imagine it kind of happens simultaneously. But thinking about different types of credit, I think is, another vector of growth for Sky.
The thing I love about this strategy that we are aggressively employing is that we can share it with other people. It's not zero sum. It's not proprietary to Framework. It's an open source software ecosystem that's focused on growing stablecoin adoption. And like, I'm sure there's some venture fund like listening to this podcast. It's like, ooh, how can we like replicate this or like do any of this? Come join us. Come work with us on this. Help us capitalize these things. It is going to be a far more productive use of your time than trying to like wish cast your way to adoption on a chain. And this is going to happen to Plasma next. This is where we're going. We're telling you right now. So there's really no secrets that we have to hold with this stuff, which is cool.
Shout out to today's sponsor, Katana. Katana is a DeFi first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion KAT campaign is live. Bridge and deposit directly into Vault in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Speaking of stablecoin land, I would love to get your guys' take on Open Issuance from Stripe here. So this is so Patrick Collison announced this week. We're announcing Open Issuance to help stablecoins go mainstream. So this is customizable smart. It's a platform basically for issuers. So the features of this platform are it's customizable smart contracts, issuance on any blockchain, reserve management, full control over mint and burn fees, and out-of-the-box interop with other open issuance stablecoins and compatibility across Stripe's platform. And they went live. I guess the first big use case of this was Cash, which is Phantom's own stablecoin that they issued via this platform. I think this is pretty similar to Luca, if you're listening, like M0, what they were trying to do. I had some trouble understanding that business when he first described it to me, but it kind of clicked reading this. So basically the idea is the bet that they're making here is that there are going to be a lot of stablecoin issuers. There are actually some challenges with being an issuer. You need kind of similar core set of infrastructure for all of that. And so that's what Stripe is providing here. I don't know if you guys have any hot takes or anything there, but I thought it was kind of an interesting.
They're changing the game by charging everyone 50 basis points to issue a stablecoin. Let's go, Kings.
Yeah, I mean, we'll see.
How about no?
Generally, I'm also in the camp that not every platform or company is going to need its own stablecoin, and that there are network effects. And just the fact that you're creating a standard and open kind of like platform for issuing your own stablecoins kind of begets the thought that you think that there's going to be hundreds of these things. And I just fundamentally disagree with that. And so I don't think that, and maybe they have like 5 or 10, but even still, then you're fighting for market share with a bunch of other companies. And it's like, well, like a terrible consumer experience, and I'm sure it would get abstracted away in some way, shape, or form. But like, oh, I want to send you dollars over Venmo, but wait, I've got PayPal, so I've got Venmo bucks, and you've got PayPal bucks. But wait, they're owned by the same company. Like, why can't these two things integrate? It's like, well,
it's a great place for an intermediary that charges 50 basis points.
Yeah, exactly. And look, I think the 50 basis points is actually 50 basis points on redemption specifically, but there will be some intermediary that steps in and like a curve that says, hey, we've got an AMM that is going to charge you some basis points. So like, I'm going to send you $100, but only $99.76 is going to come across.
Also, the other take I saw this week from, I think, Lily at the Solana Foundation, who I do think is very smart, I just think she has a bad take on this, is, what happened to Hyperliquid is going to happen to Solana, where we're going to like basically say, hey, USDC, pay us yield or else we're going to kick you off. Let's just like walk through the logic of that. So, okay, you look at a liquidity pool with a bunch of USDC in it, or like in Camino. Who do you call? Do you call Camino? They don't have the coins. You call the person who deposited. You don't know who that is. Okay, that doesn't work. And just like the analogy of the USDHL, like USDH is like a very small stablecoin. There's 150 million dollars minted. I think there's 6 billion of USDC on that bridge. Like, there's no one to call. There's no mechanism to do it. And honestly, a lot of the stablecoin providers that are putting stablecoins on chains like Solana are losing money. They're having to pay market makers to put those coins on chain. There's a certain part of those issuers like Circle that may just say, you know what, fuck it. You can pay these market makers. Come up with your own stablecoin. You can lose money on this. A lot of these stablecoins that are on these emerging chains are not profit centers.
What you truly have to have the equivalent effect is that you have to have a ticker that you're selling or some universally recognizable abstraction in your ecosystem that you then put up for sale or for bidding. But because you've already let USDC on chain, to Vance's point, you can't pull that off because those are controlled assets owned by people who have their own private keys, or some wallet structure where you can't just you can't force it to get off. So I don't think it's possible. I also don't think it's possible to have a universal abstraction within Solana that's worth it enough to where you're going to get the same bidding effect that you saw with Hyperliquid. The ticker system in Hyperliquid is new and novel and interesting, and that allows them to have the competition that they saw. But Solana doesn't have that because it's a generalized blockchain.
Yeah, I mean, I didn't see this comment from Lily, but I feel like that would be pretty tough to enforce, for sure. There's not even a guarantee, right? To your point that USDH is what takes off on Hyperliquid either, right? Like there could just be demand for other stablecoins in theory. I don't know. I mean, I agree, Michael. I don't really see a future where there's thousands of different stablecoin issuers, but it does feel like there's an incentive for certain types of businesses, like exchanges are good ones, where they're just large cash balances that are just sitting there otherwise. And if you could make those cash balances your issued, white labeled stablecoin, there's just a lot of yield that you can generate. So
right, but I guess the point is like, what's the complexity level that is still good from a consumer experience perspective, but aligns more with the business? If it's a 2x2, like the actual currency itself, which keep in mind, like not everybody wants to use USD. Many people around the world do, but there are advantages to having a local currency version. So that may be one abstraction. But if you also cross-cut that by the platform that you're talking about, and Venmo's got Venmo USD, Venmo Euro, Venmo Brazilian Real, Venmo Canadian dollars, Australian dollars, et cetera. And then it's just like, it's too complex. And you get liquidity fragmentation and exorbitant fees to transfer. And that's a terrible experience. And so nobody will use the long tail of assets, because if you cross-cut it by platform, that's going to be a problem. So I do think that there is a cut, which is local currency. And there are unique things that you can do. Like, look, Brazilian Real, the Brazilian bonds, at least priced in Brazilian Real, are earning like 12 to 14%. Like you can hold on to that and pass back yield, or have it be a business model that actually generates a sustainable business so that you can build something there, versus the 4% that you get with USDC. So there are advantages to different currencies, but I don't think it's going to be cross-cut by platform.
Yeah, I can see. I feel like Stripe's bet here is that we can get enough of the market and then make our own blessed currencies that are issued on our platform interoperable, but that'd be their bet, right? Like, I don't know if that's, and Vance, to your point, yeah, that's 50 bips, and then it's like, what are we doing here? It's similar to
just 50, man, just between friends.
Okay, last stablecoin related question for you guys. Cloudflare, we didn't get to talk about this. They unveiled their net dollar stablecoin for the AI internet economy / companies moving on chain. So this is Cloudflare, super core infra provider to the internet. And they announced on Thursday that they'll launch this net dollar, a US dollar-backed stablecoin designed to support payments for the agentic web, a term describing an internet where autonomous AI agents transact on behalf of others or on behalf of users. I've got to take here. I'm curious.
Let's hear
it.
You know what? I mean, I don't really think this makes a ton of sense. And I think that people just kind of look at it and say it's stupid.
but I do think it's one of those things that I think you're going to see a lot of people try this. And it's kind of like, I kind of bucket it in the same way that everyone is going to want to launch their own chain. And you could yell to your blue in the face that doesn't actually make sense. We don't want a world of 10,000 L1s that don't interoperate, but it doesn't mean that people won't try, because there's an incentive. People are like, there's money here. And I want to own this next platform. So I think it's just, one of a series of, companies like this that will kind of sort of see a use case and try, but it's just indicative of the fact of how much more stable coins we're going to have. I don't know.
So here's maybe like a kind of a steelman case. Cloudflare, it has been around since like mid 2000s. They've like built this infrastructure that basically is sort of in a lot of ways, like the internet gateway for the internet, where if you are running Cloudflare, as most websites do, or some competitor to Cloudflare, it enables you to not get DDoS attacked. It enables you to have extra security. Like they definitely have their hooks into a vast percentage of the internet, in sort of a minor way, but it's still passing through Cloudflare servers. And going back to the original HTTP spec, we've talked about this, I think, before, but like there is a gateway called 402 that is called HTTP payment required. It was in the original spec of HTTP because at the time when Tim Berners-Lee in 1993 was actually whenever it was actually developing this, his perspective was we need a native way of paying over HTTP, just like we have every other format for content distribution. And that never came to fruition. Intermediaries took over. And so that's why you have, things like PayPal take off, because you have to go through an intermediary on a website as opposed to having the protocol itself dictate payment. I think also historically, a lot of the kind of like core web people and now even some of the AI people still have this outdated perspective that crypto's only use is for speculation and therefore it's a scam. Like Dylan Patel, even to this day, he's the AI, semi analysis guy. He's like, oh yeah, that whole crypto thing, like that's over. That was a scam. It's like, you're obviously not paying attention. But I also know that Cloudflare people, especially Matt, who's the co-founder CEO, he's never really bought into crypto for a number of different reasons. And so what I would say is this is kind of a recognition and maybe like a light step in the direction of there being sort of mea culpa of people who are core to the internet getting behind the concept of, oh, now that we have stablecoins, and oh, now that it's regulated by the Genius Act, and oh, now that it's kind of like legitimized, oh, maybe this is interesting. Like now it's okay. And they're going to be the laggards. They're going to be the ones that don't necessarily kind of hit the product market fit because they should have been doing this or trying this 2 or 3 years ago, but now they're attempting to do it. And maybe it'll work. Maybe it is too late. Who knows? But I do think that they're in a good position to kind of enable a core internet payment experience that would resemble something that the intention of HTTP 402 was supposed to provide. And they probably won't do their own stablecoin, I would guess. Maybe they leverage USDC and maybe they just provide the rails, or maybe they want to take the whole business just like Stripe does and say, hey, this is only going to be useful if we own the stablecoin, and therefore, we're earning the interest behind the scenes. Who knows? But they have historically been a detractor and a naysayer. So I think the one interesting element here is the fact that they are now at least semi-embracing, the stuff that we've been talking about for the last 5 years.
I agree. No, I think that last part is 100% positive. But maybe I was just not following this. I'm like, why is Cloudflare, if there's something built into HTTP, like a gateway that enables payment, why is Cloudflare super well positioned to, like, couldn't anyone just build on that?
Totally. But I would say there isn't someone with as much reach across the entire internet as Cloudflare frankly has. You could say like someone like an Akamai or a CDN like them, but you wouldn't be able to do this as like a Google because it's only going to be for Google sites. But the way the internet is structured, it's like when we run a website or anybody runs a website, you set up, like your hosting service, you set up kind of like your CDN if you're a content rich website, but then you also set up Cloudflare, which is sort of your like anti-DDoS security And it's basically like a name server that routes so that you don't have a direct ping to your server. And it's basically like an abstraction layer between, any sort of ping to your website, www.whatever.com, and what your actual server address is. And it'll be like, I don't know, some namespace, cloudflare.com is like what it actually routes through. And it's abstracted away through Cloudflare. And that's just one of the services that they have. But I would be curious to know what the exact percentage is. I would guess it's a large percentage of the internet is effectively run on, like the protocol itself is actually run via Cloudflare. Also, one of the things that makes it difficult is if they have an outage, the internet goes down.
Yeah. Well, I mean, at the very least, it's cool that I agree. I mean, it's good to see some of like the more core internet people get on board, and I think those takes about crypto just being speculative or illegal money or whatever it is, they're not as dead as I would love them to be, but yeah, they're definitely getting less.
They're outdated, and I kind of chuckle whenever I hear them, just because it's like, wow, you've really missed the last 2 years. You've been heads down in some other direction. And so, yeah, recognition and a bit of a mea culpa, I think, is welcomed. Everybody can change their mind, but they're going to have to recognize, in the same way, like, look, I feel similarly about Stripe. Stripe has, been in this industry for the last decade, and they've been building the largest fintech and payments provider, the world has seen yet suddenly just now they're jumping into the space. Where were they 2 years ago, 3 years ago, 4 years ago? And they definitely had negative things to say about the industry back then, but suddenly they've changed their tune. And they, to Vance's point, they want their 50 bips now.
Yeah.
How about 75?
All right, fellas.
My inbox is really imploding / exploding. With
all right.
like a bunch of shit. I gotta hop, but good
all
to see you all.
See you guys. All right.
Peace.
Cheers.